Hello everyone, my name is Chris Urbanski. I'm the Vice President Business Development at Hahn Investment Stewards. I'd like to thank you for taking the time to join us today. We have a great presentation planned for you today, and the goal of the presentation to give you a quick overview of what Hahn Investment Stewards has to offer to you and your clients. Now, let's take a quick look at the agenda. So the first thing that we're going to do is we're going to discuss Hahn Investment Stewards, essentially giving a quick overview of what Hahn has to offer. The second thing that I want to touch up on is the industry itself. Our industry is changing, mainly CRM2. There's things happening on the front of transparency, commissions, and so forth. And once again, we will touch up on that. We will talk about the account structure that Hahn offers, mainly separately managed accounts, and so the key benefits versus a pooled product like a mutual fund or a segregated fund. And lastly, we'll touch up on the key benefits to the financial professional and their clients. And I strongly believe that there are a number of key benefits that both you as a financial professional and as a client will get from dealing with Hahn. Now, quickly moving forward, once again, a very brief overview of what Hahn, or who we are and what we do. So our whole approach in terms of portfolio management is a global macro approach, which means we don't look at any specific individual securities like a stock, for example, a CABC. We look at the global geopolitical situations, the whole global macro view. And that's a main distinction of what we do versus other managers. We are a tactical manager as well. So instead of creating a typical 60-40 balanced portfolio, what we do is we create ranges. So we can range anywhere from, for example, 80% in equities to as little as 40% or 30% in equities. Once again, depending on our view where the markets are going. We have the longest track record in the world doing what we do. The company has been around since 2002. So essentially all our portfolios, or at least 9 of the 11 portfolios that we have at least a 10-year track record. And one thing that I want to point out as well, that all the information in terms of performance that we will show during this presentation is actual performance data, meaning these are actual live portfolios. Nothing is being back tested. Some of the key benefits that we have, the portfolio management that we utilize is, in fact, client stewardship. We want to make sure that we have capital preservation as our main goal. And in fact, in 2008, 2009, our portfolios did very well compared to the industry. The balanced portfolio on average was down around 30% in 2008. Our average for the 11 portfolios that we have was negative 5%, substantial saving on the downside. And in fact, some of our portfolios made money in 2008. Everything's based on a process. We're not product makers. We are investment managers. We create portfolios. And some of our leaders in the business have a long history in this space, and I'll get into that as well. So that being said, let's look at some of our key personnel in our firm. Wilfred Hahn created this firm. Wilfred is the former head of Royal Bank Global Investment, managing different areas, including pensions, mutual funds, private client portfolios, with over $13 billion under management. He essentially built up the global portfolio platform at Royal Bank. Mark Arthur, who's also a CFA, was, in fact, the leader on the Royal Mutual Fund side as well. So you got essentially the top 2 guys from the largest bank in Canada, Schedule I Bank, RBC, leading this firm now. Tyler Morty has been with the company since the beginning. He is considered one of the ETF experts in the world, in fact, and he was named as one of the key rising stars in this space by a large U.S. publication, Index Universe. They chose 2 U.S. guys and 1 Canadian guy. So that's a big compliment to Tyler's ability in this space. Now let's quickly take a look at 4 different factors that essentially, I would say, kind of separate us from all the other managers. So I mentioned before, we use a global macro asset mix approach. Second is tactical asset management. Third is we only use exchange traded funds, ETFs, for portfolio construction. Now, I want to make it clear that we use ETFs because we believe that they're the best tools for what we have to offer at this stage. If in 5 or 10 years something better comes along, we might use those tools as well. But at this stage, we feel that for our approach with a global macro and tactical approach, ETFs make it very easy and very efficient to create a portfolio. And lastly, consistent performance. Anybody can give you, a very good year on the upside, but then the next year when the market slides, they participate as well. Our goal, once again, is to have a long-term perspective, and in fact, our goal is for the long term, we're looking to get anywhere from 5 to 8% after fees to our clients, and this is over 10 years. And in fact, our portfolios over 10 years have reacted this way. So let's just quickly touch upon every single point here. Now, looking at our global asset mix, I don't want to get into a lot of details here. We can discuss this in more details one-on-one if you're interested, and we do have a white paper that explains our process. But once again, instead of looking one individual security, we look at different factors, and in fact, there's over 23 factors that we look at. Just want to point out a few things. Market psychology, behavioral finance, that's essentially the cool thing to talk about now. We've been doing this for the last 10 years. We look at the geopolitical situation, for example, now, what's happening in Russia and Ukraine may have an impact on the global markets. So all these things are taken into consideration before we make a decision in the portfolio. Second, if we take a look at our asset allocation tactical strategy, as I mentioned before, if you look at a typical balanced portfolio, you look at a 60-40 portfolio, and it's not a dynamic process. What happens is when a portfolio goes out of sync in terms of the 60-40, the portfolio manager actually has to sell a winner and buy something that's lagging. Now, in our case, if we take a look at this bar over here, that's a total equity bar in this portfolio. So what's this telling you now essentially is that we can go as little as 30% in total equity to as much as 75. Now, this is one specific portfolio. Keep in mind, these ranges are different for every portfolio that we have, but it'll give you a very good overview of what's happening. So once again, if we feel that equity is taking off and it does have some momentum, and we feel that it's going to take a while for the momentum to end, we can actually go for a ride. We're not restricted like to be fair to a portfolio manager managing a mutual fund. They are restricted by prospectus. We are not. We have these ranges, and we can invest within these ranges. Another thing that I want to point out here is, if you look at this line, this is a typical index allocation in this type of a portfolio for total equities. Right now, we're under this, so underexposed in equities in this type of portfolio. If we take a look at Canadian equities to give you a better perspective, the benchmark is around 25% in Canadian equities. We're at roughly about 20%. And as you can see here, total bonds, we have a range from about 25% to as high as 70%. And currently we're about 45% in this range. So I'll just give you an idea of the ranges that we can follow in each specific portfolios. Another important aspect is when you're dealing with a typical mutual fund, and I'm not talking about a wrap program, but a typical mutual fund, you select a couple core portfolios and then maybe select something specific like a natural resources, gold, whatever the case may be, REITs. What we do is every single portfolio has what we call an opportunity overlay, which essentially is that component, something that's not correlated to the market, something that's a little niche, a little different, something like, give an example, something like gold, REITs, and so forth. So when a client, your client, invests in one of our portfolios, do not only get a traditional asset mix here, so this is the core, they will get the satellite. So one portfolio is enough for one client, and on average there's about 25 to 30 different ETFs in a portfolio. So if you're looking for a diversified portfolio, this is it. Now moving on, once again, I'm not going to spend a lot of time on this. We do have a presentation that specifically talks about ETFs and how they operate and some of the key benefits. I typically send it to clients, retail clients, to give them a better explanation. In short, the whole message of this slide is that ETFs by themselves are very efficient. They have many benefits, and we use them because we can now, as Wilfred says, and this is Wilfred Hahn, once again, we can build a better, more personalized portfolio for $100,000 now than he could do years ago for a large pension. And that's pretty powerful. And this is why we use ETFs. So don't get hung up on the fact that we're ETFs only. ETFs are, once again, tremendous tools for our portfolio management style, which, once again, is global macro and tactical ranges. Just to give you a quick example on that, let's assume that a typical portfolio manager would want to buy exposure to Canada. They would say want to purchase 60 of the largest market cap stocks, hence the TSX 60. They would have to do 60 trades if they want to buy that exposure. We only have to buy one ETF, which is the XIU. And that's a big factor. Even if you look at the trading cost of $8 a trade, if you do 60 trades, that's $480. If you do one, that's $8. That's huge efficiency in terms of even the cost of the trade to a client. Now, if that manager, the stock manager, wants to redeem and sell those positions, once again, that's another $480 in trades. And for us, it's another $8. So going from $1,000 in trades to essentially $16, that's where the efficiency comes in. Now, let's quickly look at our 10-year track record. And before we do, I want to just make something very clear. We are, once again, the main goal and the culture of this company is client asset stewardship. But we also believe that nobody's perfect in this business, and everybody makes mistakes. So our goal is to make less mistakes, and we feel that what separates the good managers from the average managers, the good managers essentially make less mistakes in this business. And we feel that when you talk to a manager, ask them how they did in 2008 and 2009, because that's where the bulk of the mistakes were made. And we're proud of our reaction in that environment in those years. So quickly, that being said, let's take a look at 2008. Now, please, I want to point out these numbers are gross of fees. Okay, so on average, you deduct 1.8% from here. But let's look at the domestic income balance. This portfolio with the fee was slightly down. Look at 2009, the recovery. So we're protecting on the downside and participating on the upside. And if you look across the board, this one over here actually before fees made almost as much as 9%. On recovery, again, if you look at in 2009, we're looking at our performance. Across the board, we're beating the benchmark on the downside. Across the board, we're beating the benchmark on the upside. One of our more aggressive portfolios, once again, and recovery. So on average, if you take the 11 portfolios, we were down -5 versus the average for a balanced portfolio, anywhere from 24 to 30%, depending on who you listen to. So this is one of our key strategies, making sure that on the downside, we protect as much as possible. And obviously, this is a huge benefit to the advisor, because if you do have a positive year like this, in this case, after fees about 1.2, 1.3%, and your clients are calling, the world is ending, the media is going crazy, everything's crashing, your clients call and you say, well, actually, no, Mr. or Mrs. Client, you're still positive in 2008. This is a huge benefit to the advisor. You can concentrate on many things and not putting out fires on a regular basis. And that being said, I just want to make something clear. I did this for 7 years, meaning being a financial advisor, so I know the conversations that you guys are having. So managing emotions is a huge part of the business that, as a financial advisor, you do. And when you have situations like this is a huge benefit when you don't have to put out those fires, or as many fires, when something negative happens in the marketplace. So let's take a quick look at our since inception numbers. We take a look across the board. Now, all these numbers are available on our website. Just so you know, I'm not going to spend a lot of time on them. But across the board, we're beating the benchmark since inception. And like I said, this is over now, over 11 years, in fact. Here, if you look at our two newer portfolios, these have been around for 6 years. These are focused on income. So we call these the income-focused portfolios. There's 2 of them, and 9 of them are core portfolios. These are outstanding numbers since inception, including 2008. And the standard deviation in these portfolios range anywhere from 5 to 6%, 6.5%. So really good standard deviation and outstanding performance as well. Now, I just want to point out this is an actual chart of the global balanced portfolio. I want to point out just a couple of things here. So this is an actual portfolio since inception versus the gold is our benchmark. This line over here is the world equity index, and this one here is the world bond index. Now, there's no fees deducted from anything, but in terms of the blue line, this is an actual portfolio that we have since inception. This is nothing back tested. Just want to point out a couple of things here. If you look at our standard deviation, it's 6.82 over the last essentially 10 years. World equity index 11.4, so almost double the standard deviation, and the world bond index of 9.45. So we're about 30-40% lower in terms of standard deviation. And look at this performance versus the bond index. And obviously, the last 2 years, the world equity index took a nice run up, and it's catching up. But once again, in terms of the volatility, look at a big drop over here. And essentially, it's taking from 07 to June 2012, maybe June 2013, to actually catch up. And we went down in 08, recovered before June 09, which once again, this is where the managing emotions comes in. It's a lot easier to have conversations when you can say, yeah, we're actually on the upside. We don't have to wait 6-7 years for a recovery. Now let's quickly move on and take a look at one of the income portfolios. So this is our global income focus. Once again, outstanding performance since inception, and we had an inception in June 2008. So not the best time to launch a portfolio, but at the same time, just judging by the way it's going, as you can see, the volatility is very good. Standard deviation is 6.24, and the performance is just outstanding. So let's kind of switch gears now, and let's look at some of the changes that are happening in the industry. The Canadian Securities Administration made a number of proposals back in 2012. These are coming into effect, at least some of them, and there's a deadline for 2016. The major changes occurring right now is total fee disclosure, where your clients will get a statement outlining how much is paid to the dealer, hence the advisor. So, you know, I talk to advisors all the time, and everybody discloses the fee to the client, where they say, you know, you're paying a 2.2, 2.5 MER, whatever the case may be. But it's a lot different when you actually have a client and they have $100,000 and they see $2,500 on a statement as a fee paid to for the portfolio. So I believe that there's going to be a number of significant moves within the business over the next couple of years. One is there's going to be a lot of clients looking for second opinions. And second is I believe that advisors that are not ready for this new environment may actually leave the business. And if you guys are aware of what's happening in the UK. In fact, in the UK, when these regulations already kicked in, 1 in 3 advisors have left the business or are estimated to leave the business because of these new environments. So let's just take a quick look of what are some of the proposals. One is, as I mentioned, the actual transparency. So the clients will see in terms of a dollar amount how much they will pay for the portfolio. Another one is essentially getting rid of the commission structure altogether. Another proposal is that eliminating the trailer commission by a mutual fund manufacturer, meaning that having a different class of mutual funds available where a client can go to a discount broker and buy, for example, a C class, a client class, where the management fee would only be the 1.2 and would not include the 1% paid to the client, to the advisor, I'm sorry. So there's different changes happening. And, what does it all mean? Well, the fact is the regulatory environment is evolving rapidly. We know greater transparency is coming. Deadline is 2016. And we feel that advisors need to demonstrate superior ongoing value. Now, what is superior ongoing value? And, that's a question that people ask me all the time. It really depends on a client. For some clients, it could be ongoing meetings. For some clients, it could be financial planning. So once again, you know your clients best, but the bottom line is when a client's going to see that dollar amount being paid to the manufacturer, to the dealer, to the advisor, they want to know what is my value for what I'm paying. On $100,000, it might not seem like a lot, but when you get into the $1 million range and you have a portfolio of $1 million, and even if, you structure the portfolio where the fees are low, so let's assume even 1.8% for argument's sake, the client's paying $18,000 a year. And out of that $18,000 a year, $10,000 is coming to the advisor or to the dealer. So, once again, I believe there's going to be a lot of changes because of that. I believe there's going to be a lot of people looking for a second opinion. And I believe that as an advisor, you should be ready. And this is where we come in. We feel that we have a structure and a solution that can enhance your practice and be ready for this new environment. The biggest risk is doing nothing, and I keep saying that. What should you be doing to position your business for these changes? Well, we believe that HON, discretionary asset management, is that difference. It can give you just that added punch that separates you from your colleague down the hall, your peer down the street. If it's mutual funds or seg funds, if that's the only product that your office can do, there's really nothing that separates you from anybody in that office, other than obviously those interactions with the client. But we all know that it takes time to establish trust, and not every client's going to give you business the first meeting. So you have to have something different, something unique, something beneficial that will give the client, that push to deal with you. Now, just a quick comment. Outsourced asset management, and that's what we are, is one of the fastest growing trends in the U.S. Post-crisis. Typically, Canada, U.S., we're behind about 5 years, but this market is taking off in Canada as well, and it's huge in the U.S. And just Googling outsourced asset management is going to give you a number of hits, I believe millions, in fact, that talk about some of the key benefits. So let's kind of get into that. One of the benefits is a separately managed account structure. Now, just to give you a quick difference between a mutual fund and a separately managed account, a mutual fund essentially is a pool product, and that goes for a seg fund as well. And what a client buys is they don't buy any securities. They buy a unit of a trust, and that's a mutual fund. And because it's a pool product, any actions within the pool have an effect on the client. Let me give you one example. So let's assume that client A buys a mutual fund in January, and has a very good half a year. Client B buys in June, and the mutual fund actually suffers in performance, but there will be capital gains. So the client B, who actually has a lower NAV than when they bought, is going to get a capital gains distribution at the end of the year. So any actions in the pool have a reaction to everybody who owns the pool. In a separately managed account, it's very simple. You, as a client, own your account. So if there's two clients with the same risk level, same portfolios, exactly the same, they have two separate accounts. So what happens in client A's account has no bearing. In fact, the client B doesn't even know what's happening in client A's account because it's their own account in their own name. So once again, there are a number of benefits. One is the actual client, the investor, owns the securities in their name. So if we hold 25 ETFs in a portfolio, the client is the owner of those 25 ETFs. They're not buying a unit of a trust, they're buying the actual 25 ETFs. Individual cost base, tax harvesting, which is huge. You can deduct the management fee as well. You have full portfolio and fee transparency. So once again, getting ready for CRM2, those transparencies, guess what? The client knows exactly. 24/7 access to the portfolio. They sign a fee disclosure. They know exactly the dollar amount comes out of their account. Nothing is hidden. Full transparency. Individual reporting. They get a customized report, which is very good, very easy to read as well. Now, let's just quickly look at this. So tax efficiency is very important. And let me take you to this slide first before I go back to the fee slide. This is a study that was done by Vanguard. And in fact, John Bogle, the founder of Vanguard. And they did a study on a portfolio, and they said, what determines the value of a portfolio? Now keep in mind, this is not talking about a client, but the value inside a portfolio. What's the biggest generator of value? And in fact, if you notice here, they came to the conclusion that tax efficiency is at 28%. Time invested, which is rational sense, of course, the longer you invested, the more money you're going to make. Managing emotions, and I mentioned this before, this is what our advisor, this is a big portion of what you guys do on a daily basis, in fact. Asset mix. I made this goal because this is what we do. We create an asset mix, and this is how we run our portfolio. Surprising to me was the portfolio cost at only 7%. I always, with all the news and the media, assumed that it was higher, but with their study, it says only 7%. And keep in mind, this is Vanguard, which is huge on fees as well. Security selection, once again, the old school of portfolio management, looking at individual securities, is only adding 2%. This is not surprising because there's a number of studies that have the same claim. So let's go quickly back to this slide, which is talking about tax efficient account structure, and this is a separately managed account. So let me give you a quick example. Average fee with us is 1.8% or lower, depending on money invested. Our minimum account size for a separately managed account is 100,000, but we will take accounts as little as 25, 30,000, just so you know. Typical mutual fund, seg fund 2.5. Now, obviously, there's different products, different companies, different fees. So on average, I'm giving it 2.5. There was a number of studies. One said the average was 2.56. Second study was 2.36. So I think I'm being fair here with 2.5. Now, based on this, the client can write off the fee. In this case, it's $4,500 based on 1.8%. After the deduction, they can deduct it from any source of income. Assuming they're in a high tax bracket, the effective rate goes from 1.8% to about 1.1 versus 2.5% on a mutual fund portfolio. Now, if you think about it, I haven't even talked about a product to a client. I'm saying to a client, you know what, I can save you a large amount of money just on fees alone. And that's a major benefit of separately managed account structure. Now let's take this a quick step further. What we created here, we created a fee calculator. So once again, let's look at the fee. 1.8 for a mutual fund. Let's go 2.5. Initial investment, let's say 100,000. All the mandates that we have are built in. So let's do international growth. This is a 10-year or 11-year track record. Automatically puts in the same amount of return on a mutual fund side, because keep in mind the whole point here is we just want to outline the actual fee difference. If you look at here, you can select different region. So for tax bracket, so let's just for this example do Ontario. This is an actual tax bracket based on this year. Time horizon, 1 year. On the bottom, you go output, portfolio. So the pre-tax management fees for the separately managed account HON structure, 1952, 2,700 for the mutual fund, $759 difference. So we're already saving a client $800 per year. If you take into consideration a tax deduction, the after-tax management fee to the client is $1,129.20. And this is fairly accurate based on that tax bracket. And that tax bracket can be changed, by the way, depending on your client. If you go to a mutual fund portfolio, you're looking at $2,711.50, a savings of $1,582. So just in 1 year alone, once again, not even talking about the product itself, you can save your client as much as $1,500 in this portfolio, which I believe is very significant. Now, let's take this a step further. If you look at here, time horizon, let's go 10 years. So the client's going to be with you for the next 10 years. Let's look at the output. So pre-tax management fee is $26,000 and change for HON SMA platform, $35,000 for a mutual fund. You look at $9,000 difference. You get, because of the deductions, after-tax management fees over 10 years, $15,000 versus $35,000 for the mutual fund. $20,000 difference. This is significant. On a 100,000 portfolio, this is significant. Now, there's graphs here as well. If you look at this difference here, once again, $35,000 after-tax management fee comparison versus $15,000 for HON. And this translates to pre-tax management fee as well. Here you have, so 35 to 25. There's a difference across the board, as you can see. Growth of our portfolio, assuming same performance numbers exactly, just a difference in fees. That's a substantial difference to a client. And this is a tool that we will have available for you if you want to utilize for your client meetings. And I believe this is only a sample. We're going to dress it up, but I believe this is a great tool. So let's get back to the presentation. So that being said, we feel that this structure alone, just because there's major tax efficiency, lower fees, it's a great selling feature for your clients and for you to concentrate, in fact, on, because everybody's always looking for a specific hook. I believe this is a great hook because it's rational and it's reality. Anybody would want to pay less, assuming it's the same performance in fees. That's just rational to me. So let's talk about what's in it for the financial advisor. Now, there's a number of benefits for the client, but let's see what's your benefit. Well, there's actually a number of benefits. One is reduction of compliance. Any client that you send to HON Investment Stewards, the compliance resides on HON itself, offloading the compliance from you for that client. Number two, increased marketability. Once again, having something different in your back pocket when you have a client coming in for a second opinion is huge benefit. And yeah, you can take it from a guy that's presenting for the company, or you can take it from a guy that travels across Canada and works with financial advisors. And I can tell you this, that this stuff works. And I have a number of advisors that you can talk to that are utilizing our system, and it's a game changer for their business. Even injecting a new story to your marketing campaign, just going beyond mutual funds. And I have a really great chart to show you on that as well. Reduction in administration. We do all the paperwork for you. We do all the transactional. If a client wants to cash out, say, $10,000 to buy a car, we do that as well. So in terms of saving time, the most important, I think everybody will agree, is the actual client relationship management, talking to the client, having meetings, and that's the most important. Clients know you as the relationship manager. When we can save you time on the admin side and give you the opportunity to spend more time with the client, what's the benefit? Potentially more referrals and obviously happier clients. Increase in revenue. We're saying that because we're offloading the actual portfolio management from you, the statistical analysis that you have to do when you select mutual funds or seg funds, you will have more time once again to concentrate on other business aspects of your business, financial planning, insurance, and you know what? You'll have more time to go over that insurance list and see if there's any opportunities for investment products. That is all time that we can give you based on the services that we offer. So let's look at this, the reduction of compliance. The first step when your client deals with us is the client completes a client profile questionnaire. I took the liberty to actually fill out all the questions. So let me just give you quickly an overview of how this looks. And once again, this is available on our website. We can easily send it to you at any time. So I answered all these questions. Nothing very specific. I just did it very quickly. Once all questions are answered, and let me just quickly make this bigger. When I go back to the top, press recommend mandate. A box comes out. And as you can see, the following is a summary of recommended portfolio solutions. So for anything over $100,000, the recommended portfolio is global growth. For anything under $100,000, you go into the Jove Growth ETF portfolio. So essentially, even the process of selecting the managers or the portfolios is offloaded because this tool does it for you. So let's press OK. Now, if you notice another thing, I'm sorry, I had my apologies, some technical difficulties with that file. But once again, it will send it to you, and you can do it at your leisure. If you have any questions, we can always have a conversation. But essentially, the whole point of this is it offloads you having to do any type of analysis on a product. It selects this product for a client. And what I was going to show you before it actually went away is that you do have flexibility. If you don't agree with one of the selected mandates, you can actually change it if you prefer. So quickly moving on. When I showed you increased marketability, let me tell you what I actually say to clients when I meet them with advisors. I always say that in the past, big, large institutional clients, even individual clients that had the $5, $10 million, they always had discretionary portfolio management. But most clients, we don't have $5 million, $10 million. So we start with a bank deposit, move to GACs, mutual funds, maybe wrap programs. Some even go as far as doing individual stocks and bonds. But once again, we didn't have the $5, $10 million to be in the space. Well, Mr. or Mrs. Client, based on HON and our process-based approach, we can take you to the same level as your pension at work, but you don't need $5 million anymore. And, this is going beyond mutual funds. Not to say that mutual funds are bad in any way. They're a great product for many clients. But if you have those clients over $100,000, the higher net worth clients, this is a great tool to say, now you're part of a different club. You're in the highest level of account supervision, which is discretionary portfolio management. And just from my experience, I can assure that clients enjoy that. And there's many benefits, once again, to going to this level. The separately managed account structure, the lower fees, the tax deductibility, and so forth. Reduction in administration. I'm not going to get into this in much detail, but we do have a form, what we call a discovery questionnaire. There's a picture here, once again available online. What the advisor or the assistant of the advisor does is completes this form. It's very basic. Name, what account, where the money's coming from, if it's a transfer, beneficiary information, so forth. Once this is completed, this, along with the client risk profile questionnaire that we completed, is sent to our admin team in Winnipeg. The admin team will complete all the documentation for you, including all the transfer forms, and will send you the pre-populated forms to you for client signature. So, going and me being a financial advisor, filling out the large forms, long forms, even for seg funds, insurance, that's essentially eliminated for you, allowing you to concentrate on the client meeting versus doing the paperwork, because Han does it all for you. So once again, a major reduction in administration. And some advisors say to me, well, you know what, I don't really do admin because I have a admin assistant. He or she is very good at it. I don't have to worry. And I say that's great. But if you can have a team doing this for you, and then you can have your admin assistant concentrating on something else, meaning business development, maybe planning a seminar, doing webinars for your clients, and so forth, different projects, that will add to the bottom line of your business, versus doing admin work. So I think there's a major benefit of offloading the administration work. So what's in it for your client? Once again, access to discretionary portfolio management. The separately managed account structure itself is way more beneficial in many cases than a pool product. Consistent benchmark beating performance. Once again, we may not be for all your clients. If your client's looking for the 20% return per year, we're not going to deliver that because we plan not to deliver it. We're looking for a consistent, low volatility, once again, 5 to 8% after fees over 10 years. Access to some of the world's leading ETFs. Now, not sure if everybody's aware of this, but there's over 4,000 different ETFs available worldwide. You need a team of specialists to decipher that information as well, and we do have a team of specialists at Han doing that selection process for you. Ongoing portfolio review. Once again, comprehensive portfolio reporting. And I always ask clients, retail clients, when I meet them, do you really know who your portfolio manager is? And I think that's very important. When you put them into a Fidelity whatever fund, Mackenzie whatever fund, what are the chances of that client actually interacting with a portfolio manager? In some cases, if they're a large client, maybe, but in most cases, not. In our case, our portfolio manager sends an email to every single client with a monthly presentation, so the communication is there. If you want to do a webinar for your clients, I can get Wilfred, the founder, to do presentations. That's all on the table. We, in fact, we pride ourselves on helping advisors with their business, so that's our goal. So keep that in mind. And in fact, myself, I go to many client meetings. So if you're not comfortable positioning this for the first time, I'll be more than happy to either have a phone conversation with the clients with you or going to a client meeting with you in person. And that's what we offer as well. So there's many things that we as a company, we feel that we offer to help your business. So just lastly, just so we fully understand the structure, because this is a separately managed account, the client actually opens the account in their own name, and they do it with a custodian. We have 2 custodians available, Fidelity Investments Canada, which is actually a huge custodian. Second is TD Waterhouse, Institutional Services. Just one quick point on TD Waterhouse. TD Waterhouse sold their services to NBCN, National Bank. So I believe the process is taking place now. So soon it'll be Fidelity Investments and National Bank. So your client will actually get a statement from Han and from where the money is. So they will get a statement from Fidelity showing exactly what inflows are, outflows, any transactions. Once again, full transparency. They also have 24/7 access as a financial advisor. So at any time you can go, if you have a client meeting, print a statement as of last business day. And I believe there's over 60 different ways that you can print a statement. So as detailed as you want or as general as you want. Now also, because we're part of IROC, clients do fall under the Canadian Investor Protection Fund. That means that up to $2 million, $1 million for open non-registered and $1 million for registered. Now this protection fund, just so you know, is only if Fidelity, or in this case TD Waterhouse, goes out of business. The client will be compensated. We never keep the money. We actually don't see the money. So it's sitting at a client's name at these two institutions. So that's it. If you want any further information, you can feel free to give me a call. This is my information. I will also send this presentation out. So if you want to use it as reference for client meetings, feel free to do so. But if you have any questions on any of the topics here, please let me know. One thing that I want to mention is quickly, because I forgot to mention it before, and it's quite important, on the fact that your client can deduct the management fee. We deduct the fee as one amount, so the client gets to deduct the full amount from any source of income. And in fact, we have a way of making the registered money tax deductible as well, which is a huge benefit to your clients that have large registered portfolios. And that's something that we can discuss offline as well. So I would like to thank you for your time. And once again, if you have any questions, feel free to contact myself. And this number is actually my cell phone number. I'm available at all times. And our goal is to help your business. I hope to be working with you very soon. Once again, all the tools that I showed you are available online. The calculator, I believe, is a great tool to show the client just the difference fees make. And that's going to be available very shortly in terms of a more presentable marketing piece. So once again, thank you very much for your time, and hopefully we will talk soon. Thank you.